So I'll just give a quick introduction for those that don't know you. You are the co-founder and the CEO. So you're the co-founder of AI Seed, which has over 45 investments
Yep.
out there, and then you are the CEO of Capital Enterprise, which has a whopping 576 investments in different companies. And you tend to stay in the machine learning and technological space when you invest. So
Definitely then we invest personally.
yeah,
I mean, to give you context, the companies that we basically have invested in, it's actually the vast majority of those are through the accelerators that we've co-funded. So it's actually the accelerators, the Entrepreneur First, the Techstars, the Seed Counts, etc. But I mean, so we're one step kind of removed.
okay, great. Now, can you just walk us through a bit about how you came to be where you are? Because I know, so you have these two that I just mentioned, but you also have other companies that you're advising. You're also actively raising funds for. Is that correct?
Yeah, I mean, I'm to give you kind of some background. I fell into this side of the market in around about 2010
Hmm.
because previously I was on the other side. I was an entrepreneur,
Okay.
and I had an entrepreneur experience about 11, 12 years, and my arc was the wrong arc. My first business was an SQL database business. We did reasonably well. I then did another business that ended up becoming consultancy. And then I did a hardware business, which I lost a fortune on. So my arc wasn't kind of where you're supposed to be, is that you start off, you fail, and you get better and better. And as you well know, in the fifth act, it all comes right.
Yeah.
I had the slightly different arc. And so in 2010, I basically was effectively relatively broke.
Hmm.
And therefore, I was looking for an opportunity. And there was this moribund organization, although probably that's a wrong phrase. It was a effectively semi-dormant organization called Capital Enterprise.
Hmm.
And I was asked to, at the end of 2009, beginning of 2010, would I come and work for it, take it over? They could pay me 1 to 2 days a week. And could you do something with it? And at the time, I had a failing startup. And I felt that would fit in because I was still hoping to turn that around.
Hmm.
In 2011, I eventually finished. I left that startup, and it basically, but it's no longer operating as it was. And basically, and then in 2011-12, I started to work almost full time in Capital Enterprise to build it out. I then became an angel investor by accident.
How does
When
that
I
happen?
had an exit in 2004,
Uh-huh.
and when you get an exit from your business, you don't get all the money straight away.
Mm. Mm.
And actually, ours is a bit odd, but I won't go into details. But eventually, I got actually my final payment in the end of 2011, beginning of 2012. So almost 8 years, basically, after I exited. and at the time, I tell this story because it is true, but it's also kind of slightly illustrative in a sense. I remember getting that check, which is roughly about £200,000 left of my last check from that exit. I'd gone through all the rest in different things, but also a very failed startup. And I was at the time with my partner going to thinking about buying a flat in London, in an area of London called the Haringey Ladder, which is in North London, because my partner had worked out that since 1991, that 2-bedroom flats in that area had doubled their price every 4 years. So you had a history of over 20 years of if you bought a 2-bedroom flat in 4 years' time, you would have had double the price.
Yeah. So why wouldn't it continue?
Yeah, and it has actually. But at that time, I was also working in Capital Enterprise, and I was starting to see the emergence of the London tech scene. I was starting to see lots of tech businesses, and although my first business was software, my second was consultancy, my third was hardware, I was getting back into those kind of wonderful times about thinking about startups and believing when I was a startup and getting that excitement back. So I remember telling her, I think I would be better off taking that money and being an angel and actually investing in some of the startups I see.
Wow.
The truth is I was a terrible angel. I could go back to why. And me and my partner split up about a year later. And if I had bought that house, that flat, I would have that flat now. I think she used to send me on Facebook every month, every
Oh,
quarter,
that's nice
what
of
the
her.
price of the flat was that we were about to get. And if that flat, the last time I looked, we were going to buy it for 240,000. Last time I looked, it was £720,000. And of my investments I did with my just under £200,000, I made 8 investments. I basically had one small exit, twice my money back. The 6 have died, and I got one left.
And no
And
flat.
that's because the truth is about investment. It's about anything in life. Basically, you can either get lucky, you can go to the plate and you can swing the bat and you can knock it out. And we all love those films. You know, The Natural. Who just, all they had to needed was the opportunity. Someone just had to throw the ball in the thing, came out of the crowd, hit it for, kind of a home run, and everyone applauded. That and we all have that beautiful idea, but that's all it needs. It's just
Yeah.
just the opportunity to get to be in the plate, take the swing, hit it for a home run. But the truth is most things like investment, it's about learning. It's about basic experimentation, and it's about basically getting a much more deeper understanding and much more experience before you become good at it. And that's my kind of anecdote, where a lot of things, and the same about being an entrepreneur. Sometimes it is about being in the right place at the right time. And on my business in 1998, we were in the right place at the right time. And sometimes you're in the wrong place at the wrong time. When we were doing my hardware business, we were doing okay, and then the 2008 crash came, and we never recovered. And then we started to make some really bad decisions, but that's a different story. But a lot of it is about hard work, it's about perseverance, but most of it is about learning. It's about acquiring knowledge from basically experimentation, from experience. And eventually, hopefully, if you last long enough in it, you get good at it.
Yeah, and that is something that I wanted to ask you, because I know that when I reached out to a friend who actually has been on here, Charles Radcliffe, he said, I said, "Hey, do you know John?" He said, "Everyone in the London tech scene that it has anything to do with AI or ML knows John." So that was one way that I realized, let's try and get you on here. Let's try and see what you have to say because of the
It's
experience.
same with that. It was an accident, to be honest. I could say so, because my background, I'm not. I didn't do computer science at university. I actually did philosophy. There you are. And actually, AI was one of the things I actually specialised in as a theoretical subject matter in the 90s in UCL, London University. And I got interested in machine and AI, probably like a lot of people actually, around 2014, 15, with the big breakthroughs that came actually 2 or 3 years before. And then the movement of basically using particularly machine learning, is almost synonymous, deep learning methodologies. And what at the time, I should have come back a step. In 2015, I was running another fund. And that fund was a generic fund, and it did seed. And we started to see companies come out of our universities, in particular in the UK, who were building machine learning, startups. And they were being assessed on the same way that a company that was basically doing food delivery was being assessed. And we would basically try and pitch these companies basically to our co-investors. Our fund was a co-investment, London Co-Investment Fund. And they would go, "Well, I don't really care what's under the hood. I don't really care about the technology. Just show me how quickly they can get to market and get traction." And the truth is that when it became apparent, really, in 2016, that we needed a new fund. And in 2016, 17, we set up AI Seed. Partly because we knew that these investments are different from quick to market, quick to build, basically products, where the real risk is market risk and not product and technology risk.
Oh, wow. How interesting. Now, you're going through because you have all of these investments that you basically you have under in your portfolio right now. At any given moment, how many deals are you evaluating?
Well, I should say where I am now. I mean, one of the reasons I'm able to talk to you is actually um, both the funds I've ran since 2015, so that's 5 years. Both of them are now what we call capped out. We have deployed our capital. So I'm in that kind of position now where we're what we call in the harvest period. We've made our investments, we advise our portfolios, we have no more money to follow on. We have little bits, but not much. And my role now is to basically support them and try and raise another fund.
Mm-hmm.
So, and it's interesting about the London scene in particular. I think I put out something at the beginning of this year that I am no longer investing. And I went from receiving something like 30 to 40 decks a week to now receiving 4 or 5. Because as soon as people realize all he can offer is advice, he actually can't put money in. He cannot, like, and so it's slightly more reflective. And actually, the truth is, it's slightly out of kilter. We were and we are trying to raise another fund, but that's been particularly set back by COVID. And that's going to probably take an extra 1 or 2 years. And so at the moment, to keep my eye in the industry, to kind of show that I have, still seeing good deal flow and to see where the trends are, I am an advisor and basically on a couple of other funds, which basically means not a lot really. I help them source deal flow and help them assess it, but really it's their funds. But I at least, would get invited to the, to participate.
Yeah.
When we were in COVID, invited to the pub once a week for a drink and a
Mm.
natter. But really, I'm not really investing on my own convictions at the moment. I'm advising a few others. I'm sitting on lots of boards. I'm basically, but I'm not an active investor, which is strange for me because I've been active investing now as an angel and running 2 funds since 2012. So it's the last 4 months. Is the last check I wrote was in March. So what's it now? June.
Mm.
So
and what would you say, like as a rough guesstimate, how many deals have you seen over the years?
Oh God. Oh God.
If you
Yeah.
had to quantify it.
Well, the peak when we ran the London Co-Investment Fund, we saw. You see, VCs lie about this, by the way. They all think it's a real vanity metric. You get VCs and say, "Oh yes, we see hundreds of deals." They don't. What you're really saying is that have you basically received a deck, read the deck, and responded to basically the startup that sent it to you, or the introducer that sent it to you. And at my peak, I would have probably done 2,000 a year.
Wow. Wow. Yeah.
I mean, last year we probably saw maybe 300-400, and we made 15 investments last year.
Now, what stands out when you see these, when you're going through 2000? What is it that you're looking for?
Well, actually, it's not that hard to spot the good ones. I mean, despite what you say, because there's a hell of a lot of Me Too.
Yeah.
I'll tell you a story. I once, basically, this is in 2017-18 when AI started to really hype. And everyone decided to put AI or machine learning in their deck. So, I'm basically a food delivery, but really I'm an AI food delivery. I'm a beer manufacturer, but I'm an AI beer manufacturer.
I'm a co-working, but I have.
Yeah, but, so, and I remember going to an event, there was 5 other VCs there. And basically, we all had to do a reverse pitch. So what's about your VC? And there's an audience, apparently just AI startups, apparently being pre-vetted. It's about 100 there. It's in a big auditorium, and we had to do our pitch. And then we would basically have our desk to, me and my colleague, and we'd wait for the startups to come up, sign up to us. And I remember basically I was the last one on because my name's Spindler, so they did it by surnames at S. And the others said, "Oh yes, we love blah blah blah. We want to see X and blah blah blah. This is all really exciting, etc." And I said, "So I suppose our distinction as an AF fund is that we do technical DD. We will look under the hood and we will try and understand your technology and your vision and how you're able to kind of execute on that. And so we all stopped, and then we all had to wait for the startups to come. And for 3 hours, we didn't get a single startup that came to our stand.
Because
There's
nobody
no one,
wanted you to look under the hood.
because they didn't have anything. And I think actually that started to stop, because it was actually very detrimental to startups who were AI to claim that they were. One of the big things you always should know is you hear this a lot, fake it till you make it. It's rare, but that will work. And generally, if you lie, you're out. If you say you're something and you're not, you're out.
But yeah, I think I remember you telling me that it almost became too cliche when you would see someone that put AI in their name, and it was almost like not an instant disqualification, but
someone said recently that COVID is a new AI, because that's what virtually all the decks people see now. People are trying to kind of put, trying to squeeze in some COVID relevance, to try and kind of think, because they want to. People think, I want to tell the investor what he wants to hear.
yeah.
And it's a very good temptation in life. Tell the teacher what they want to hear. Tell your partner what they want to hear, kind of, et cetera, and therefore they will then somehow grant you. And some investors are not very bright, and sometimes they do that. So, but the key thing I think for most is that if you say you're an AI company, there are 3 things that most investors have a problem with. First of all, investors don't understand AI and machine learning. In the US, only 9% of the dollars go to deep tech, which is AI as a category within that. In the UK, I would say it's about 5%. The number one thing, especially angel investors, especially at seed investing, is things they understand. So if you say, I'm an AI company, machine learning, blah, 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 you are basically trying to, most investors don't understand it, and most people will not want to invest in something they don't understand. The second big thing is really important, especially for angels, business angels, people that put their own money in, is a lot of the time business angels put their money on, they're looking for social proof. They're looking for social acclaim. They're looking for basically their community of friends to say how bright you are and how smart you are. So if you are one of those individuals and you put money into an AI company, your friends are going to say, hi, John, what do you know about AI? And you go back to step 1. You don't know anything, and therefore you look like an idiot. And then the super bright people who are basically see a machine and AI, they're really the small minority, but basically will know the one big fact about machine and AI, which is often overlooked in all the press. It is bloody difficult. It is really hard to build out a model that will consistently work. And most basic machine learning AI projects are very disappointing in what they can achieve. It's pretty tough. And although you get lots of debates, as you well know, every day I see another thing, basically kind of linear regression is better than deep learning. Well, anything basically that works. I mean, it's a toolkit. If you can get linear regression working, yes, it's simple, it's explainable. Fucking hell, it's a lot easier to do. And if the problem basically is fit for a linear regression model, use a linear regression model. What the hell are you trying to do by building a kind of very complicated, basically neural network solution?
Yeah, it reminds me of the other day we had Dan Sullivan on here, and he was saying how he spent all this time, making sure the f-stops were perfect and just really tuning the model. And then later, once it got into the people's hands that were actually using it, they said, oh man, we can't do anything with this. And they don't care about how many f-stops you have. They don't care about.
And we've all got a real big problem. It's really hard to get it to work from the lab to the field. It's really, you train it on toy data, you get real world data. Real world data is really messy. Your results dissipate. It's tough. And when people say to me all the time, machine learning will be a commodity, haven't you looked at GitHub or TensorFlow and seen all the models? I said, it's not, but there's 3 things I would say about that. One is that you would almost say, I would say almost 100% certain that every one of those models have been overfit for the data they were built on. 2 is that the trick is transfer learning. Transfer learning is incredibly difficult. It's an experiment. There's very few, and like all experiments, you get better more if you do them. So actually, the human in the loop, the person that's trying to take the model and apply it, it has the and in most cases, even if you do that, it's still not good enough. You often have to go back to the fundamentals and build your own model, your own engine, your own data capture, basically kind of devices, basic processes, etc.
So can you walk us through maybe a few deals that you passed on and later they were successful?
Well, I've passed on quite a few. Basically, the biggest one I passed on, and I suppose was when in 2015, and I passed on a deal by a Russian guy called Nicholas and Freeman team, and they were building um, basically a kind of fintech product, which is now has a lot of machine learning in it, and that was a company called Revolut.
Oh,
And
yeah,
and
I've heard of them.
and at the time, the valuation was about £4 million. I think now it's something like 4.5 billion.
Yeah. Yeah, it's pretty big.
And what it taught me is that the problem with the fund I had is that we had to invest alongside basically some other named funds, and we had about 10 of them. And the two funds that basically we had to co-invest in, I couldn't invest on my own without them. We didn't have enough money, and the rules were as such, but we had to have someone else to come in. Is that both of them passed because they said, come back to us when you have traction. And basically, Revolut had traction, but they hadn't monetized yet. So what they were effectively saying, come back when you can prove that your business model, how you make money, works.
Wow.
And that basically, if anyone's tried to raise investment, you will often hear that. There are 5 big risks when you're making an investment. Every investor looks at the same 5 risks. We all weight them differently. We all do slightly different things to assess them. And we obviously, on that weighting and that prioritization is virtually everything. And it's pretty simple, actually, how we do it, particularly at seed, prior to business model data. And one of them, increasingly at early stage, which I think is often wrongly applied, is the business model. Prove me that you can make money. Prove me that your cost of acquisition and your lifetime value basically means that there's a company there that can generate cash flow that can fund future growth.
But then when they, like, for example, Revolut, if they came back and they already had proven it out, the investment is just astronomically much bigger, right? Because they've proven that they're a great company.
Well, yeah, it's true, but there is you have to be braver, and there's a couple of things I suppose we might get talking about what it's like to try and invest at seed, because it's very different to invest, as you point out, when you're already scaling and there is basically your business model is proven, your tech is relatively proven, your team is relatively proven, and most important of all, you've got presence in the market, so proving that the customers want it and keep on using it, keep on buying from it. Then it's a different way. You can build a financial model, a business model yourself to assess it and predict where it will be in a year, 2 years, 3 years, 4 years time. And therefore you can do the arbitrage. If I bought shares in the company today and it carries on doing this, the shares will be worth this. And there is the spread. That's when I invest, etc., etc. But it's very much difficult when there is not that data.
Yeah.
And we get a lot of people in machine learning and AI come to me and said, I will build you a prediction model for investing in basic companies. And I said, can you do that without data? And they said, no. I said, well, then go and see the Series B guys, the guys with the big offices in Palo Alto and Sand Hill and Mayfair in London. They're the ones that have the data because they invest when there is data. We invest without it. And so we have to basically, we have models, we have ways of assessing it, but they're quite subjective.
And so when you're looking at these different seed investments, if you don't have the data, what is it that you base your investments on?
We do the same criteria. We look at 5 things. So I'm actually tell you, and you look at the 5 risks. So you're assessing risk and reward. It's as simple as anything. If you think about that, it's a risk and a reward, and in the end, obviously, the reward, the reward you will get has to be worth the risk you're about to take. And so the risks you look at are execution risk. Do you believe the team can do what they say they can do? Do you believe they're credible? Do you think they're capable? Do they have some advantages which are, hard to replicate? Do they have an executional plan which you're confident that they can actually put into basic practice?
And you do
The kind
this
of
by going to the pub with them, or
Well,
by?
what some of it is quite simple. You say, okay, what are the challenges and tasks of building this out? Let's look at you. Can you do them? Well, give me some evidence that you can do that. Have you built one of these models before? No. Okay. Do you know any customers? No. Okay. Can it, it said, have you worked together before? No, I just met him. Et cetera, et cetera. So there's that, the execution risk. There is the market risk. Is there really a problem to solve? Is there really a group of customers that presently in the market have a need but can't be sated, can't be addressed? And can you address that better than the competitors, the substitute products themselves doing it themselves? And do you have a way and a method to get to them and convince them to do so? So are they customers? Are they really customers? Are they really, really customers they're dying to get them? And then you have the product tech risk, which is in machine learning often the big one, which is, can they build it? Can they build it? And can they build it so it's best in class? Can they build it so it gives a fundamental performance gain beyond basically straight rules-based software?
Yeah, that's an important one.
And then the fourth one is the business model. Can you make money from it? Can it make money at scale? Is there a kind of business model, at least in theory, that says how you can make money? And then the fifth risk is my risk as an investor. How do I make money by investing in you? And that will be about how I source my money, what my expectation is, what my risk assessment is, risk tolerance is, et cetera, et cetera. So a pitch book, I think it's 2017 now, looked at a 10-year cycle since the crash in Europe, maybe 2018 then, basically on what the returns was if you were an investor investing in tech startups. And they found, I think the figures were 6% return on capital if you invested at seed. So every time you invested in the seed, you had a 6% chance of getting your money back. It was 18% at Series A and 40% at Series B. And since that came, there's been a massive pile here, the States, China, everywhere, to try and invest in the ones that look like the proven winners and invest big. So about 95% of all the VC money is later than A, B, C, D, E.
Yeah, I actually just saw an article about that, how Series B is still going strong.
And the reason is because basically investors are not investing for you to solve the problem. They're not investing in you to kind of build a team. They're investing in you to dominate a market, to become one of the players, become a monopoly player if you can. And that can only really be assessed once you've done your first scale. And so that's the kind of data they're looking for. And so those are 5 risks, and there's actually 5 steps. So I seem to be stuck on number 5. Which is in startups, you go from idea. So you've had an idea in the pub. The next step is commitment. You do something about it. You start building something. You start telling your friends. You start putting a team together. It goes from an idea to something. You go. The next step there is first signal. You get some signal in the market or in the technology, etc. It says this can work. Customers love it.
Yeah. And
then you go from first signal to basically what we say is data, product market fit. And first time we have some data that suggests the product works, the customers love it, and you can make money at scale. And the next kind of tip is, can you scale? Can you actually take something and start to scale and dominate a market? And there's the 5 steps, and most investors invest in transitions from one step to another to move you from, say, commitment to first signal, or first signal to data, or data to first or second scale.
And so you said before that there's lots of, you get thousands of pitch books, but it's pretty clear which ones are the good ones. What is it that makes them stand out? What makes the good ones
Okay,
very obvious?
and every investor has a thesis. I say we all emphasize. And when we were running AI Seed, we made our thesis that actually the winners will be the people who can build the best technology, or can actually solve the problem. And we particularly invested actually quite a lot in regulatory industries where you have to prove that before you're allowed to trade, like finance or health. That might be wrong. Actually, we'll find out in 2 years' time if that was a wrong thesis. But we emphasized above anything else the product tech risk. And so everyone we invested in the end, we invested in 50 companies, of which 3 are dead. One's exiting tomorrow, actually, our first exit. And we started off in 2017.
Congratulations.
And 46 are still there. And most of those, we see the initial challenge in a deep tech startup is that can they solve the engineering problem? Can they make a machine learning product work better than a rules based? If not, why bother? And only when you can do that can you basically start to scale up in terms of the getting customers and scaling the customers. Because most initial customers for machine learning products are co-creators, co-collaborators. You are selling something which isn't really fit for purpose. And you're hoping to basically work with their data and with their patience to prove that you can get something which is much better than they can do themselves or better on the market, et cetera, et cetera. And that takes trust, and that takes time. And so it's whatever people think. And this is very different from, say, when I invested in simple SaaS, basically companies using rules-based. It would, if it worked on day 1, it would work on, day 30. I mean, all you did was bug fix, which are obviously a lot of, and you concentrate a lot on the friction points of adoption. How to make it simpler, easier to use, easier to understand, blah, blah, blah. You have to do all of that in machine learning, but you also have to fundamentally make sure that your model works. If it's analytical or predictive or prescriptive or tries to automate, it must achieve one of those. Otherwise, it's a very costly product for the customer. You bought a car without an engine. And actually, when we were in the States, when I went to the States in 2017, the model in the States, which I used to invest in as well, and etc., came very much in what happened in the mid-noughties, when we had a lot of people looked at the failure of the dot-com boom and looked at some of the kind of reasons why that happened, and looked at the type of startups that in future you have to do, and came up with techniques such as lean startup, agile thinking, design thinking, business model canvas, all these techniques that came on there to kind of try and effectively run a system. So you basically kind of support the startup to overcome the initial barriers, so they can get to a situation where you can say that this company is now able to scale. And the truth is, most of those risks were market risk. Now, will it solve the problem for a customer, and will customers love it? Will customers use it?
Yeah,
and anyone's ever been through a lean startup process, it's very much around customer development. And all of that. And I think in machine learning, you have to do that as well. You have to do that as much as anything else. But you also have this second thing: is can you build it? Can you actually kind of do that? Because the truth is that we've invested in 2 types of machine learning company. We try to invest, I think probably of our 50, probably 4 or 5, but I try to tackle really deep problems in machine learning. On annotation of data, on basic deployment of models, on the infrastructure, on basically trying to be best in class in facial recognition, or something there where there is normally a data set you can judge basically the quality of the model on, which is publicly available. And you're trying to say, we think we got the best team out of Imperial or KTH in Sweden, or et cetera, et cetera. And we're going to back them, and they're going to basically, on our money, carry on doing research, but do it against a specific thing, but a challenge where we think if you can unlock that, people will want your talent, will want your team, want your technology, want your IP, and you can get an exit.
Hmm.
So we've done maybe 4 or 5 of those. But for most companies that we've invested in really early, for them to basically go from a tadpole into a frog. And what I mean by that is initially their technology is not fit for purpose. They have to spend the first year, 2 years, sometimes even longer to try and take their technology. But once they have a technology that basically works, a prediction model that works, a time series data model that is best in class, and they have clients and they can prove that this works, they have to productize that and then become like any other tech startup focused on capturing market share.
Mm-hmm.
So when they're a tadpole, they have to swim and eat and basically build, et cetera, et cetera. But as soon as they actually got that stage, they have to then metamorphose into that frog and basically have all the kind of characteristics of a frog to take that market.
And what have you seen companies do well as far as that transition goes? Is that something that, because I imagine it's going from having a strong engineering team with a very small sales team to then expanding the sales team, or is it bringing on some developer relations people?
Yeah, it's both. It's both. It's definitely the case, and we've got our teams now going for that, because when I was investing in SaaS plays, that process of iteration, agile thinking, building your product, testing it, sending it out, getting feedback, spending a hell of a lot on the UX, adapting, blah blah blah. Normally, that you have a good team, you'd find out that would be the first year, maybe up to 2 years. And probably you got a machine learning, they're still doing it 3 years later.
And that's something that you had mentioned last time we talked, is the expense of investing in these machine learning startups and how expensive it is just to make sure that the product gets out there.
It's expensive out there. It's expensive to build, and also, like, we have a lot of compute power issues. A lot of your guys will find it's easy to get very early stage free credits from Azure, AWS, Google, etc., etc. But once you start to scale it, they will go incredibly expensive.
Yeah.
I have a startup at the moment, and other investors today on the board meeting I was at was saying, well, why can't you reduce the latency down to a matter of nanoseconds? Because the cost on the GPUs, the cost of compute to get it down there is much more than the client's prepared to pay.
Yeah.
And so you have these kind of, but they're not used to that. You're used to saying it's a piece of software, it's in the cloud. Who cares?
Uh-huh.
Because it's not trying to do enormous, complicated compute at speed. When you don't, if you do parallel process and all the rest, it's still going to be expensive.
Yeah, and do you feel that's what I've seen some startups that try to attack that very cause, that they're building hardware for the machine learning and data science space because of that. But it's very true that when you're first trying to prove out this model, it's like the 3 cloud players, the first one's free, and then once you're hooked, you're
And it
in.
comes to expenses. People look at great companies. We have some great companies in the UK. We have, that have merged out of here. And obviously most have been bought by the big tech companies. Famously, probably DeepMind out of UCL got bought basically, in its very early stages. We got 2 or 3 years after, by Google, and now you have over 1,200 basic researchers, and in King's Cross next to UCL's campus, basically working for DeepMind, possibly the #1 research AI research private sector institution in the world. And you could debate whether some is better than some public ones like Stanford or Carnegie Mellon. But the issue for VAM, and when they do really expensive basic reinforcement learning models with all of Google's basic enormous kind of compute power, and you try and then apply them to the same models in an early stage startup, you just don't get anywhere near.
Yeah, it's impossible to recreate, and especially on your own. If you're not coming with that kind of horsepower, you can't do much.
I mean,
So,
we've invested recently in quantum computing software companies, about 3 of them, 4 of them, and most of them are building in simulation based environments using machine learning.
mm,
And ironically, they're doing that because to get onto the basically, the dream waves and the kind of gate systems and the ion systems, et cetera, is so difficult. And there isn't many of them, and they're so difficult to work on. It's easier to build your models in a simulated quantum environment than actually the real quantum environment, et cetera, et cetera. So they look at the compute problems in machine learning as a simpler kind of option. So there's always someone worse off than you, and on
yeah, I love that. So now, can you talk to us about things that you're a bit bullish on since COVID hit?
I think COVID's difficult across the board, and actually, even in areas you think that basically it should give it, and it will give a good, possibly give a good area a longer term boost to, because it's. I think what COVID is instead, there was a great good Andreessen article, I think, about 2 months ago, saying that basically innovation, people aren't crying out for innovation. Generally, when you show innovation to people, their response is defensive. You threaten the infrastructures, institutions, their own jobs, etc., etc. So the great thing about what's happened in COVID is that in certain areas like cloud compute, like telemedicine, it has forced institutions and people who had previously said, over my dead body, to have to overnight go all cloud, or basically, doctors in particular. Doctors have been very, very anti telemedicine or remote diagnostics. Now it's all they can use, so that's kind of, and it turns out not to be as bad as they thought.
Yeah.
So, so, but even those, it's been difficult. It's not a perfect game. It's about timing. Was your product ready just when it happened? Imagine COVID would happened 18 months ago. Imagine we now all were doing this on Skype. Imagine Zoom wasn't really known, or basically didn't have the infrastructure, didn't have the backing.
Yeah, the adoption wasn't there.
Could only basically serve 500,000 people because that's all it's kind of got. Imagine trying to do this on Skype, for God's sake. So a lot of it is timing. Going forward, I don't know. I mean, next week we have in London basically Cognition X, which is the big AI event. I think I'm on 3 panels trying to, future gaze of what's going to happen, and I don't know. I go from I like yourself. One of the big issues you probably have in AI here is how do you model this black swan? It's out of the parameters. And never mind whether you feel there will be a second wave, which I think there probably will be, and the implications of that. Never mind where, do you think there'll be a vaccine? I think not, because I don't think we've put as many vaccines ideas into development as we should. It's a stochastic method and requiring you to 1 to 3% chance of any vaccine working. So generally, just like seed investment, you've got to spread your money to around lots and lots. And it's a good example, actually. You could ask why. I mean, in the UK, for instance, we had about 10 vaccine programs and we backed 2.
Wow.
And the reason is a little bit is, I think it's the perception of failure. If you back a vaccine, it doesn't work. Basically, you look bad. The politician look bad. The institution looks bad. Investors look bad. But it's an experiment, and experiments fail. That's the reason they're experiments. And therefore, it's kind of they backed one at Oxford, they backed one at Imperial, they didn't back one at Cambridge. There's another one at Imperial. There's another one at Oxford. There's one at UCL. There's one in Belfast. One in Glasgow. There's lots. Never mind the ones that were basically exactly happened in places like France, Canada, Germany, America. Exactly the same. Not all of them got funded.
Yeah, that's so interesting. And talking about this idea of failure, how do you look at that? Because I know you've gone through your fair share of ups and downs. as you mentioned.
The truth is that if I've got only a 6% chance of returning capital, then I can't, and I'm investing at a stage because it's 6% because there's not much data. I reckon I can add probably double that. I'm confident about with my knowledge and my pattern recognition and the good source and etc. I can probably say I'm getting that to 12%. But there's probably not a lot of things you do in your life where you have an 88% chance of failing. So how do I do that? I do it by spreading. You know, if I was a Series B fund, I would probably make 3 or 4 investments a year. I'd probably see not too less than I see, maybe half the number, but you know. But as a pre-seed to seed investors, I have to make at least a dozen investments a year to give myself a chance that. But if one makes it, they can make enough money to afford all the others not.
Yeah. Yeah, that makes complete sense. And is there any deals that you've seen that you were convinced were going to be successes and they just never went anywhere?
I had a deal. I've got another one at the moment, and actually, it's really interesting. In machine learning, one of the real problems is mass annotation. You know, how do you take unstructured data and structure it and categorize it correctly before you can apply your? And I've since we've done this since 4 years, we've had people with great credentials coming up and saying we have a mass annotation kind of system that can annotate raw data and turn it into things that can be put into nice columns that you can then do your time series data model on or whatever. And I'm a sucker for those. And we had a great team once came out, what's at a university, came out of a university and a company called Palantir. And they came to us and we were lucky to see them and we got talking to them, we got quite friendly, went down to the pub, but they already had, when we met them, some well-known investors, big VCs in the European scene, already offering them term sheets and money. So it was almost like a politeness. We're going to see you, John. We don't need your money. You haven't got enough to give us anyway. And I remember basically we were the only people that kept going back to them and said, how are you going to try and do this? You know, how are you going to do this? And they said, well, we're going to try and do this and this. And so, well, that can't work because of X. And that can't work because of Y. And etc. We kept kind of, and in the end, I've got to say to this team, I can't name them because they're quite well-known people, they decided not to go ahead. And they gave the money back. It was serious amounts of money. They had to sign term sheets. I don't know if the money went from into their bank account, but they cancelled the term sheet and gave the money back because in the end, they worked out, well, actually, this is such a difficult problem. They're not quite sure how to do it.
Oh, wow.
And I think there are still big problems in machine learning around taking data, taking raw data and structuring it. But are still there because otherwise it becomes incredibly labor intensive. And using mechanical Turk to annotate, you don't get much.
Yeah, it's so interesting that you talk about this because yesterday we were talking with Robert Monroe and he's a very big proponent for this human in the loop. And we went real deep into the human in the loop and how to create a culture around that, why you should be using it and what it is first of all, you know, this active learning and all of that. And it was really interesting, his view on it. I asked him, well, do you think that this will ever change? Will we ever be able to get past this and not need the human in the loop? And he said that in his opinion, it's not going to. And he didn't want it to either because there's a lot of things that he would like to have a human opinion on. So
I think there's something on theirs, and this is a danger thing for machine learning. I think I agree with him, but it's where in basically the chain where the human comes in, and how much. The danger of all machine learning basically is they become bespoke projects. They become research projects to look at a unique data set with unique tools and build a one-off solution for a one-off moment in time for a single company. And you could say for every one machine learning company, you probably got about 5 consultancies out there at the moment saying, I will build you one.
Yeah.
And the truth is, as I keep saying to them, that they're buggers to basically build, but they're even worse to maintain. It's feral software. It is software that goes wild.
Yeah, which is
So
so.
kind of like, so a lot of people don't want that. They want, because we've got to a stage in society where we use software. I use software all the time, lots of tools, without really knowing what's under the hood and expecting it to work perfectly every time.
Mhm.
I'm not having to basically kind of pull out my metaphorical spanner and open up the bonnet and basically work out what went wrong.
Uh-huh.
But that's, I don't think we'll ever get to the stage of machine learning where we're going to be able to have that. And neither should we. We're trying to, in many ways, make them intelligent. And just like humans, they will make mistakes.
Mhm.
The
Yeah.
truth is whether the payoff is worth it. That is the of all the things that we look in machine learning, we got a system is the best is a nice way to describe it. It's not. We have a very real heuristic about assessing basically machine learning propositions. We stole it from basically kind of a guy called Matt Turk, who's a famous VC in New York.
Mhm.
He published something around 2016, and we thought that's good. We'll
Let's
use
use it.
that, build our own version around it. So I had met him once. I didn't tell him I stole your system, but I had. So I don't know if this is publicized, it'll come back. But he has a 5 things. It's all alliteration. It's called the 5 Ps.
Uh-huh.
So you look at so the first one is the people. Do they have the skills, the expertise, the background, credibility, the experience of building basic models?
Mm.
And and in many ways that's probably the most important. And then you basically look at the next P, which is the product. And the key thing I want to make about the product is, does it create value for your end customer? How does it create value for them? What does it do that they can't do now through a rules-based system? And actually, we get a lot of machine learning companies that end up simplifying and actually actually they may have started off to want a very complex, say, deep learning model, but are actually using simple symbolics
Yeah.
to basically achieve the same thing because it's easier, it's quicker, and actually it doesn't, it's not worth the cost and the complexity to try and basically kind of go for a deep neural network model on that. So the product, it's all about the value it creates for the customer and whether that's worth it, because you are taking a big risk by doing this, and sometimes it may be not worth it. We then look at the process. So what machine learning models are you trying to build? And most people use a basic compendium of different, across the base, and they have to be fit for purpose.
Mm.
I mean, are you categorizing? Are you clustering? Are you basically, kind of predicting, et cetera, et cetera? Then we look at the petabytes because we like alliteration. So that's the data and the source of the data and what type of data, and it's a first order or a second order data company, et cetera, et cetera.
Uh-huh.
And then we look at finally the positioning. And as an investor, I try and avoid ever going head to head with Amazon, Google, kind of Tencent, Baidu. I'm looking for kind of models and places where people don't wake up in Mountain View and say, I really want to build a computer vision model that solves this problem in this industry.
Yeah, that's probably for the better. That's who was it that told me the other day? They said, yeah, you're fine until Amazon enters into your market, and then it's game over.
Well, sometimes you're right, or sometimes basically Amazon will then find how difficult it is as well. And I mean, some markets are never going to be massive, and my fund's quite small, so we can have a company that can basically and potentially dominate an industry. The industry itself might be relatively small, or might look big, but actually in terms of what they spend on basically, prediction, prescription, automation is pretty small.
Hmm.
So
Yeah.
for instance, we've invested in a couple of companies doing computer vision in agriculture. So we've done a company called Observe, but basically does computer vision in very murky water in Norway, in Scotland, and Chile to basically count and predict the weight of fish, mainly salmon or trout. And that allows basically those fish farms to basically optimize on their kind of feed and the basic, and the health products that they give them.
So when they
And
came,
that's a kind of business I don't think someone in Mountain View is going to kind of do. And it's a really quite a difficult computer vision problem because
yeah.
fish move around, the quality of the basic light's pretty poor,
Hmm.
et cetera, et cetera. Kind of there's an inductive basic problem there as well, because obviously you're trying to do a measurement as well as basically a categorization issue. So it's a good technical problem. It's not something the industry is going to solve itself.
Hmm.
But
But
it's
it's quite
also,
niche.
yeah, but it's pretty niche. And I don't expect that company to end up basically being $1 billion company.
Mm.
But I do expect it to be quite a good company.
Yeah. And when they came, when the guys or girls from Observe came to you, did they already have that model built out and it was working and they showed you, hey, this is it?
They
Or
had a basic model. You're quite right. They had a model based on some toy data. What they were actually is two guys from a university called Imperial who were really pretty hot on computer vision. And they wanted to find a problem that was hard. And someone suggested, have you ever tried to count fish in murky water?
that's amazing.
And
So
now
this,
Rishi, who runs that business, is as urban as I am. Basically is often in wellies in the middle of basically fjords in Norway or and Chile or in lakes in Canada,
wow.
kind of speaking to these people that run these enormous fish farms.
And making sure that his models are proven value for him.
Yeah, it
That's,
was nicely and kind of and it's also an interesting thing because he's got a data source. They already basically have cameras on the kind of fish to make sure
uh,
they'll get predators in and things like that.
okay.
So it's not like where you mentioned earlier where you sometimes the only way you just know data, you're gonna have to build the entire hardware to capture the data before you can actually apply any models.
Yeah, here it's something that they already have.
And we've got I just invested about 4 or 5 months ago in another company called Flocks, by another a British guy called Imitias, and that's effectively counting and predicting the health of chickens in big chicken basic sheds
Wow. Wow.
using infrared cameras and things such as those.
So again, it goes back to finding more of a niche problem that is solved by this machine learning rather
Yeah,
than
and
something.
to give Flocks, they've got ambitions to once you get the data to build products on top of that data. So this is another thing we've noticed recently is initially people were building tools. So here's the tool. We don't care. Pay us for the tool. Maybe we'll do it as a SaaS model, so it's easy for you to pay a subscription each month, as opposed to a yearly license. But fundamentally, that's more about a marketing thing and realize, kind of etc. We keep it updated, etc., etc. But increasingly, we've had people looking to say, okay, yes, we can do that. Yes, we can build a better categorizer or a better prediction model. But what can we do with that data ourselves to build a big business?
Yes, because right now, yeah, the data is the important part of it.
And sometimes it's getting imagination. I mean, we have a company. It may not work. We have a company that have, because they're academics in one of our big universities, I've got access to the largest data set of patient records in the world for people with type 2 diabetes. And they're trying to build a prediction model from early signs, looking at their patient records, whether you can predict very early whether people will progress to get type 2 diabetes.
Oh wow.
Now, generally, you would have basically said that great, you can do that model, and you would basically have a model, and maybe who would you give that to? Maybe you would give it to doctors, but probably you give it to people like insurance companies, and they would use that data on your model to try and make money. And all the money, and they'd pay you a few £100, maybe a few £1,000, but they would basically make all the money on basically how they deployed cash and making these insurance
Mm-hmm.
budgets, etc. Well, they're not doing that. They're building a model and then going to build an insurance company themselves on top of it. And these are two data scientists, two PhDs. So, we backed them and think they're going to be, we hope they're going to be bloody marvelous. And initially, the challenge is taking that data, which is enormous, but obviously it's not perfectly structured. There's structure in it, trying to build a model, try and test that model, etc., etc. But they're not going to stop there. And then they're going to raise again, get more commercial people in, and to try and kind of then take an industry and build a whole new product. They want to produce a health and lifestyle, a health and life insurance product for people with type 2 diabetes who are presently excluded from those markets.
Oh, wow. Wow, that is so interesting to hear. And this idea that the data is the really important piece.
The data is really important to train your model. The
Mm-hmm.
real importance after that is can your model then work on live data?
Yeah.
So then it's, and you've got to be, it's an art not to overfit.
Yeah. Yeah. And of course, if you're thinking about creating some kind of startup with a machine learning spin to it, how are you going to get this data? How do you have the data that you're going to be
Well,
using?
sometimes they have to be very imaginative. I mean, we've backed a lot of teams that have come out of university, and actually, universities for years have been said they must be the crucible of where great innovation goes. But it's mainly, as you well know, if you've ever worked in university or studied there, or done a PhD or a postdoc, generally the output is another paper. And another paper, and another paper, maybe some basically peer acclaim and recognition, and et cetera. Very little comes out and commercialized. And the great thing about machine learning and how it's affected not just the computer science department, but every other department in our research universities, is it allows you to do the experiments while you're doing your studies, and to get really good, and to get often better than people work in the real world, because you're giving more license to do the experiments, and also to access to data sets which are not available in a public world, because you always have to pay for them.
Yeah. Okay.
And so that's, there's if you invest in machine learning, you hunt in universities. If you invest in SaaS companies, you probably wouldn't.
Yeah. I can see that correlation. So we're 4 minutes over. I really appreciate the time you've spent here educating me on all of this. I find it fascinating, and all of your endeavors, everything that you've been able to get
And
over.
I would love to find out. I mean, I need your community to tell me what's going on in DevOps, what's going on in the core, what tools that are being used, where do you lot feel the next? I mean, because that's a community I don't play in enough.
Yeah. And that's something that I think that we are all learning together right now. And that's what we're really figuring out. And as you know, there's something new popping up every week. And right now, what I was going to mention earlier that when you were saying that, and I love this term, it's rabid models. What did you say? Or they're
Feral.
feral. The models
Wild.
are feral.
Yeah.
And that's something that for me right now, I find monitoring and the monitoring of models once they're out is just fascinating. And what is it exactly? What is it doing? Is it doing what it said it would do? How did you train it? And when you trained it, did it do what it's doing now? And like you mentioned, when the data sets completely change, when there's this huge anomaly or something like COVID hits.
And you're making trade-offs. I mean, in the health sector, as you know, we're all very, very conscious now between the trade-off between sensitivity and specificity.
Yeah.
False negatives and false positives, and the kind of implication that has, and where do you want to put the kind of limit, and how much on for instance on antibody testing at the moment, because it's never perfect.
Yeah. It's fascinating subject that I find I could sit here and talk to you about this all day. I really appreciate the time you've given me already. I will let you go
Happy to
because I know.
talk, and I
Yeah,
hope I've got or get some interesting people come to us and say, I actually got something interesting here, and I hope to be back investing at the end of this year.
there we go. And so if someone did want to get a hold of you, what would be the best way to approach you?
Through you, Just
Groovy.
get
There we
yeah,
go.
and I
There
keep
we go.
using my
I'll give
filter.
out
Yeah,
I'll
yeah,
give out
give it
emails
out.
for a
You think, yeah,
special price.
just I don't mind if you think they're good guys and good girls. Just get them to just give my email out. You have it.
Perfect. Perfect. Otherwise, they can find you on LinkedIn. You're
Yeah, they
active
can
on
find me on
there.
LinkedIn, etc., etc.
And I'm going to thank you one more time. This has been really informative. I have learned so much on how things go, and hopefully someone is able to approach you and find and get a deal out of it. Hopefully you like what they have.
Yeah, brilliant.
And yeah, that would be a great success story. So if anyone in the future does happen to do that, please let me know, because I would love to hear these kind of things. Now,
Thank you. Good
thank you
night.
so much. Yeah, have a great night. I'll see you all later. Bye
Thank
bye.
you. Bye bye.